and this is Josh Jalinski, the financial quarterback. Don't touch that dial. The Fed has cut rates. So now what? Big money news out of the Fed this week. They cut the benchmark federal funds rate by 25 basis points, moving it down to a range of 4 to 4.25%. It's the first cut since December. Money markets are now down a little bit. They used to average about 4, now they're averaging about 3. And it's being framed as a risk management move, which what is the management? What is the risk that they are managing? Who are they trying to risk manage? Reacting to softer job growth and emerging signs the economy may be cooling. So let's break down what this means for your mortgage, your bank accounts, your investments, and what plays you should be considering now. So the federal funds rate is the interest rate that commercial banks charge each other for overnight loans to meet reserve requirements. The Fed meets and they set a target range for this rate, which serves as a benchmark for other rates, and it does influence everything from mortgage rates and loan rates to savings rates at your bank. So by adjusting this rate, the Fed manages the money supply. So think if rates go up, it is going to restrict economic activity and hopefully cool inflation. If rates go down, it's going to stimulate activity and hopefully fight deflation. And it influences overall economic activity. That's the kind of the definition in a nutshell. There's many different things of why it matters. So whoever chairs the Federal Reserve is a very powerful person, and they're not elected. They're appointed by the president. But it's one of these things that everybody talks about it, and I think the average person is really clueless on. Now, think of it as a tool. Now, I don't even know if the tool works, right? Because there have been, if you study the history of the Fed, they've been wrong most of the time. And whenever they do something, it's usually too little, too late, or not enough. And people think, so I think they're sort of like the Wizard of Oz, that there's not really much there. But everybody believes they have power. Therefore, they have power. And they're probably way more influential than most people realize. So basically, but that's the market moves based on the Fed. But I sort of think the market is going to do what it's going to do no matter what the Fed. So now realizing that they have this influence on borrowing cost, monetary policy, all of these things, and we're a financial show, we got to talk about it. But how does it affect your exact money? By the rate that you pay on your car loan, your home loan. Directly, it's affected by it. Now, it's not like they announced they're going to cut and then next week they're lowered or next day. In fact, I believe what happened last week is they lowered rates and the 30-year mortgage spiked up a little bit because they had already lowered 30-year mortgages in anticipation of the rate cut. So what's the average 30-year mortgage rate right now? Do we know?
Says as of today, the national average for a 30-year fixed mortgage rate is around 6.34 to 6.37%.
Yeah. So like before this announcement, I don't know, maybe they were 6.5, 6.6. But they started lowering them kind of in anticipation. So for example, according to Zillow, rates around 6.304, and Bank of America was around 6.25% on September 23rd. So September 6th, Zillow had it at 6.304, September 23rd, 6.25. So it ticked lower a little bit, but not significantly so. And then I'm looking at, go to the Fred website. Fred's a great website for data. The Fred stands for the Federal Reserve Bank of St. Louis. They have a lot of interesting charts. So if we go to the 1-year chart, September 18th, it was 6.26, the average 30-year mortgage. The average 30-year mortgage a month ago was about 6.5%. The average 30-year mortgage July 17th was 6.75. So Trump is trying to put pressure on the Fed to lower rates so it can spur an economic activity because rates have been high. People can't afford that monthly mortgage payment. But the negative when rates go down is you make less at the bank. You make less on money markets and savings accounts. So the high, January 2025, the average 30-year fixed mortgage, 7%. Now, if you've been around for some time, you lived in the 80s. I have clients always say, in the 80s, I paid 18% for my mortgage. But this 7% spike that we've had the last few years has been the highest, basically, rates have been since 05, 06. So it's almost a 20-year high. So I certainly think there's political appetite. So when Powell says we're doing this for risk management, I think there's a couple different risks. One, they're worried the stock market's going to go down and they're going to get blamed for it by the president, which is kind of what they're not supposed to do. They're supposed to do what they think is right for the economy. So shame on them. Number two, they're sort of in a thankless position. If they keep rates the same, they're going to have the president after them, and they're going to be blamed for any type of recession. If they lower rates too much, they're going to be blamed for any inflation. But there's been news that inflation is not cooling. So I don't know why they're cutting rates, personally. Let inflation cool, then start cutting rates. So I think when he says risk management, what he means is he doesn't know what the heck's going on, but they're lowering them just in case Trump's right. Reacting to softer job growth and emerging signs the economy may be cooling. But I don't see signs the economy's cooling. People are still buying homes. People are still, unemployment is very low. So let's break down a little bit more about what it means for your mortgage, your savings, and investments. So the Fed lowered rates by 1/4 point, as we talked about, because job gains have slowed. Inflation is still elevated, and the overall outlook is a bit more uncertain. But we are at all-time highs on the S&P 500. So maybe we have a little short-term high and a little 5 or 10% correction off the high. But generally speaking, the economy looks very strong. AI investment, despite the cut, policy remains modestly restrictive. That means they think rates are still going to do their work to tame inflation, and they're not committing to a rapid-fire series of cuts. The Fed's forward guidance and projections suggest that there may be 2 or more cuts before the year end, depending on how incoming data on jobs, inflation, and consumer spending shapes up. Let's talk about winners and losers from the Fed cut. First loser, I'm going to do the losers first. The first loser is the Fed. The Fed has really lost its credibility. I don't know. I feel bad in a way, like they can't really do anything. But I remember Ron Paul called for auditing the Fed or ending the Fed. I'd be all for that. I don't think they're really adding anything of value. Ever since the creation of the Federal Reserve, our dollars have gotten less valuable as they use monetary policy as a tool to devalue our currency. And to me, it's like the emperor has no clothes. There's really nothing there. Of course, short term, They impact us. They impact our lives. They control our lives. You know what's crazy? The average financial person, everybody is a financial person, whether you're into it or not, is influenced by the Fed. Just think about that. What your biggest thing in life to realize? There's 3 things that I tell people at our first meeting. One of them is the 4 rules of financial institutions. What are those rules? And I consider the Fed a financial institution. The government is a financial institution. They want your money. They want it little by little. Every month, they take something. When you want it, they give it back to you like in a pittance. And they control the rules. So if you think about it, your life, the subject of your whole financial future, is not something that you can control. Isn't that crazy? Now, you can be responsible. You can go out, get a good job. But there is so much of your life, that's why I believe in God, that we don't control, right? You don't control interest rates. The Fed does. You don't control tax rates. Congress does. You don't even really control your job, right? Because you could get fired. Or me, I own my own business. I'm an entrepreneur. I don't control my life. In a way, you control but my clients, right, dictate. If you have a family, your spouse and kids. So there's a lot of our life that is beyond our control. But one of the crazy things that the Fed has done since its creation is lower the value of our dollars, making our money worth less over time. And there's a financial genius, Bob Castellone, who created this little saying that I love to go through with clients on the 4 rules of the financial institutions. And I want to say this the right way. I've said this before in meetings. If you're not careful, you may be dealing with individuals and institutions who want your money. They want it systematically. They want to hold on to it for as long as possible. And then when you want to return it, they return it to you little by little. And you might be saying, I can go out and pull my money out of the bank. It's fully liquid. I don't get it little by little. Try. Go to your bank and say, I want $10,000 today. They'll make you fill out a form. They'll send a report to the government. And in some cases, they will not give you more than $3,000. So you don't control as much as you think you do. It's one of the reasons why Bitcoin became so popular, because people didn't want a intermediary between them and their money. So the big loser, I think, is the Fed, because people are kind of growing tired of this. The lower rates, and then we'll realize inflation's still here. Take housing. We looked at Nicole's town, and how many houses are for sale in your town?
3.
3. That has nothing to do with the Fed. So if rates are 7%, or if rates are 6 or 5.5%, and this is, I think, what Trump is not fully understanding. He does talk about it, though, when he talks about all this land in the country that's undeveloped. I firmly believe the reason why housing has stayed very high is because people don't want to sell the homes they're at that they bought with a 3% mortgage.
That's the exact scenario my parents are in.
Yeah, like my mortgage is I think my mortgage is like 2.5%. Why would I ever sell? I'll just rent my house out. There's no reason. Maybe I get top dollar or something, then I'll sell. So most people don't need to sell. And I would argue this problem was created by the Fed, which had rates too low for too long. So people bought bigger homes they could have maybe afforded otherwise, with cheap and easy money. That is not going to be solved if we have another 5% loan or a 6% loan. It's only going to be solved, frankly, if rates maybe go back down to 3%, which is, I think, why Trump's trying to have it go to zero. But I don't even know if that would be good for the economy. I don't think it would be. When you have interest rates very low, artificially low, it creates malinvestment. People chase bad investments because money is flowing. It's easy. And it creates all these series of unintended consequences. So I think the losers, number one loser, the Fed. Number two loser, people trying to look for a home. They still can't get a home, even if rates go down a quarter point, right? You looked at it after our show and it was still, so the Fed cut rates a quarter point. Did it do anything? No. They're going to cut another quarter point. I think we got to have rates at like 3% for it to really change economic behavior. And I also believe environmental mandates. Now, I'm all for the environment, clean water, but I believe in New Jersey particularly, we have way too many open spaces where people cannot build anymore. Conservation easements and this and that. And that's fine. Love the environment. But it's creating an unintended consequence that people don't have affordable housing. So that inflation, I don't know, will ever come down on houses for a while. We have to have like some type of recession or stock market crash where people feel like they really need to cash in their homes. That make sense? I don't think it's going to save us to have lower rates. If anything, it's going to hurt. You know what's going to hurt? Third, savers. I have so many people almost on a daily basis who I meet with who have 200 grand in cash on the sides, 300 grand of cash on the sides, 100 grand of cash on the sidelines. Even though they know they should be investing it, they don't. Because, hey, they're making 4% on their money at the money market. Now, what are the money markets making? On average, 3%? Let me go to the website we use for a lot of our clients, Fidelity Money Markets. So if you need to make more at the bank, you can call us. Put you in a money market that gets you probably more than what your bank gets you. So one such is FDRXX. It is, I don't know what the yield is now. The yield is 3.87. A little bit ago, it was like 4.48. So it's ticking down. I talked to a client. He said, "Oh, are you getting a good rate?" She said, "Oh, yeah, I'm getting 4." I said, "Check it again." Told me it was 3.2. So it's starting to tick lower. So if you are a saver, you will be a loser in this. Savers are losers. You ever hear that? Now, I'm not telling you it's bad to save money. I'm just saying you are going to have to figure out where to put your money because you want to lock in these rates we're experiencing now for the next 5-10 years because I think rates are headed lower. Why? We have a president hell-bent on lowering rates. 2, he's in charge of who's the next head of the Fed in a year. Because I think if you're going to cut rates, you got to cut them lower to spur economic activity. I just don't know if it will.